Welcome back to our channel. Today we're going to discuss the Fibonacci retracement tool. So Fibonacci was an Italian mathematician that lived in the 12th century in Pisa, Italy, and he is famous for producing the Fibonacci numbers or the Fibonacci sequences. So the Fibonacci numbers are a row of numbers where if you add the first and the second number, you will get the third number. And if you add the second and the third number, you will get the fourth number. So for instance, by adding 0 and 1, you get 1. By adding 1 plus 1, you get 2. And by adding 2 plus 2, you get 3. And this will basically continue indefinitely. So what is so fantastic about and fascinating about the Fibonacci sequences is that they're embedded in nature. You can find them technically everywhere. So they're in animals, especially seashells. You can find them in plants and flowers and so on. And you can also find them in financial system, which is basically fascinating. So the way you use Fibonacci is that Fibonacci retracement levels are horizontal lines that indicate where support and resistance are likely to occur. So this is basically a tool in order to that helps you identify support and resistance levels. Fibonacci retracement is created by taking two extreme points on a stock chart and dividing the vertical distance by the key Fibonacci ratios. So when we have financial markets, it is basically ratios that we estimate from. So these eight ratios are the 33.6%, the 38.2%, the 50%, the 61.8%, and the 100%. So the main ratios here are the 38.2%, the 50%, and the 61.8% ratio. So here we have a chart of oil contracts, daily chart, and if we were to use our Fibonacci tool, it would look something like this. So what we do is that we take the highest point to the lowest point, and on the right side, we can see that we have our ratios. We have 38.2, we have 50%, and we have 61.8%. So if you look at the price levels, you can see that many of the high price levels will hit these ratios. For example, here we have the 61.8, the 61.8 again, 50%, 38.2, 38.2, 38.2, and the 50%. So this indicates that we have resistant levels at these current ratios. And this is a selling opportunity because sellers can come in and basically sell at these high points. So we have a bearish movement, then we have a bullish movement that hits the 61.8%, then we have a bearish movement, then a bullish movement, we hit the 61.8% again, then we have a bearish movement, a bullish movement that hits the 50%, then a bearish movement, then we hit the 38.2% 3 times. 1, 2, 3, and we then hit the 50% once we have a retracement, and then we go all the way up. So if the 61.8% level ratio gets broken, prices tend to go to 100. It is not always, but in most cases, prices will go to 100 and then they will bounce or they will break 100. They most likely bounce. So we have an example of that here. So in this case, we had take the lowest point to the highest point. And notice that the ratios are opposite. Now we have on the top, we have the 38.2%, the 50%, and the 61.8% ratios. So here we have some points that hit 61.8%. We have a bullish, and then we have a bearish movement to the 61.8%. Then we go up again, and then we break the 61.8% level, and we go all the way to 100, for example. So in this case, it would be buying opportunities. So at these points where we hit the ratio, the 61.8% and the 100%, buyers could come in and buy at these current levels. So the Fibonacci retracement is probably my favorite indicator to use. However, like all the other indicators, it is not possible to just use one in order to determine where you have support and resistance levels. You have to use several indicators in order to determine whether or not you have support or a resistant level. So the next time we're going to discuss the MACD. And if you like these videos, you're welcome to subscribe to our channel and click the bell button in order to get notification of our next video. Thank you very much.